Hi, I'm David Ross from Direction Accounting and Business Coaching, and I wanted to talk to you about tax planning, what it is and why it's very important at this particular time of the year. We're coming up to end of financial year, 30th of June, and every man and his dog is out there screaming at you, come and buy this from us and you'll be able to save tax. You've got the car yards. You've got Harvey Norman out there telling you to come and buy the big screen TV. You've got Officeworks. You've got the printing and stationery company. You've got every man and his dog telling you what to do. And none of those are tax experts. The important thing here is to get great advice. Don't speak to the guy over the fence. Don't speak to the good mate. Don't speak to the guy on the job site. Don't speak to the guy at the pub. Get great advice from your accountant and your advisor. So where I wanted to take this is to talk about some of how we bring together your tax planning and how that becomes important. And I see a number of key issues when people are looking at tax planning. The first is that they will typically throw a whole heap of money at things that they don't need because such and such told them. And sometimes, unfortunately, that's an accountant that tells them that. Now, if you don't need something, then don't spend the money on it just to save tax, because at the end of the day, you're possibly only saving between 30 and 40 cents in the dollar tax anyway by buying that particular item. The other 60 or 70% is coming out of your business, and it's money that you possibly should keep in there to make sure that you can take advantage of all sorts of opportunities of things that you actually do need. So saving tax is not necessarily the best thing. And I know you think I'm crazy when I say that, but sometimes it's better keeping the money than trying to just get 30 or 40 cents in the dollar back. Now, the second thing is, as I mentioned, listening to people with well-meaning advice. We work in what's called a self-assessment system. Now, you can claim anything in your tax return, and as long as you're not audited, then you can basically walk away and get away with it. Now, I say to people, you could claim a red Ferrari in your tax return and get away with it until the tax man came knocking. So when you talk to other people, there's two key things. One is their circumstances aren't the same as yours. Guaranteed. Everybody's tax circumstances are different. You have to look at the detail. The second is that the person over the fence who's telling you to go and buy that Dodge Ram has probably got away with it because nobody's coming knocking at his door. Now, I'm not saying that you can't legitimately claim a Dodge Ram, but there are circumstances that need to be met to allow you to be able to claim that. So be very careful when you're looking at those particular issues. The other is not really understanding your average tax rate. Most people are looking, oh, I'm paying way too much tax. Oh, they're taking a third out in tax. But when you actually look at the average rate, with the tax-free threshold taken into account, then most people are leveling out between about 15 and 25%. Now, the company tax rate is 26%. So all these people that say, oh, I need to be a company to save tax, are really thinking about it the wrong way. So what do we do when we're going to go in and do tax planning for a particular client? So the first thing we do is we look at your year-to-date figures. And we then start to build some estimates through to the end of June. So here's what you've done so far, maybe to the end of March, say. That's normally a common period that we look at. And then we say, okay, what is your business going to do April, May, June? At this time of year, we're typically saying, well, okay, show me what you actually did April, May, and then let's have another look at what you're going to do during June, and let's see where things are going to take us tax-wise. We then do a tax estimate based on that. Now, if you've got a business group, so you might have a company, a trust, you might have a self-managed super fund, and then you've got individuals. So you need to look at how all of those pieces come together. There might be wages, dividends, all sorts of things taken into account when we get to doing the estimate. So it's not a simple process. It's not simply going out and buying an asset and writing it off 100%. We'll come to that a little bit later. Once we've got the estimates, what we do is we then do some what-if scenarios. Now, what-if scenarios are really important, as are the estimates, because this year there's a few key things that you need to be looking out for. You need to be looking out for the accessibility of your JobKeeper, because that's coming back to bite some people. because normally they would have the full amount of their wages to claim as a tax deduction. If they've been lucky enough to get into the JobKeeper system and be eligible for that, that JobKeeper that they receive from the tax office is assessable income and offsets what they would normally have as wages. So they're going to be more profitable than what they were last year, depending on how they've gone turnover-wise. Now, obviously, if they've been eligible for JobKeeper, there's possibly a downturn, but it may have been a downturn only in a certain period of the year. And then they've had this spike back up, which a lot of businesses have experienced. So it's very important to look at that. You also need to look at what's called cash flow boost. If that's sitting on your profit and loss, that's a non-assessable item. So don't think that you've necessarily got an extra, say, $10,000 worth of income when actually it's not going to be assessable to start with. So there's a number of other things that come into play when we're looking at the estimate. So once we've got the estimate there, we then start to look at tax strategies. And I'm going to put together another video which will cover the relevant strategies that we can apply, some of the key things that we look at when we're doing tax planning. So keep an eye out for that one. Once we've got the strategies there, then we need to look at actually implementing those strategies and getting them in place so it's all set and forget before 30th of June rolls around. So if you need to have a keen eye on your tax planning, if your business has maybe done well this year, or maybe not done so well because there's now some loss carryback rules that we can apply. So very important, no matter what you do, if you're in business, you need to be looking at tax planning for the 2021 financial year. If you'd like to have a confidential chat about your tax, simply comment tax below or get in touch with us at direction.com.au and we can help you get in the best tax position before the end of financial year.